Welcome back. This is Brian Kurtz with PremierRealEstateInvesting.com. We're going to be talking with you today about lines of credit in our episode of Funding Fundamentals. Lines of credit are an awesome funding source. They've been used in different ways, either by investors to fund the entire deal itself, where they use a line of credit to fund the purchase as well as the rehab costs. Sometimes, though, we see investors using lines of credit as what we call supplementary financing, where they use this type of equity line or a unsecured line in order to finance just maybe the rehab portion or the rehab portion of the closing costs. So somebody may use a hard money loan to actually fund the purchase for the main purchase price of a property, and then use a line of credit in order to fund the repairs and the rehab and maybe even the closing costs. So pretty much what we see these days, investors like yourself are going to gravitate to one of two types of credit lines. Either they're going to go with a home equity line of credit, which is tied to their primary residence, or to an investment property residence. Kind of harder to get that one going right now, but or people are going to be using unsecured business lines of credit. Usually not so good to just go out to the bank and say, hey, I just want an unsecured line of credit on my personal credit report. Usually that's not the best idea. But either of these types of funding are going to work pretty well. And how it works is you just get it all set up, and then when you need funds, you draw down from your equity line and you go do what you need to do. Now, let's talk about the differences between the two. Now, a home equity line of credit obviously is an equity line that's attached to your house. So if you don't have any equity in your home, which seems to be the problem that a lot of people have right now, then you are probably not going to be approved for one if you don't have one already. Furthermore, if you already have an equity line that you're not using, we find that you can look in the news and find out about this. There's plenty of stories right now where banks are canceling people's equity lines. So you may be thinking, hey, I got my equity line ready to go today, and they determine by whatever internal process they go with that, hey, we don't think you have any equity in your home anymore, so we're just going to call you up or actually usually just send a letter and say, sorry, we're closing your equity line, we're not going to do it anymore. Call us back in 5 years. So that is kind of one of the negative sides to it. The other thing is that your equity line, your home equity line of credit, if it's tied to your personal credit report, is going to be showing balances running up and then coming down as you're buying properties, fixing up and selling them, and then refinancing back out of them, and buying them, fixing them, selling them, or refinancing back out of them. The balances are going up and down, which is usually not such a good thing for your personal credit profile. The scoring models don't understand what you do. They expect to see credit go up and down in a very slow pattern on personal credit reports. If they see things going up and down wildly, then it confuses and concerns the scoring model, so it can have kind of rough effects on your personal credit. Businesses, however, are treated differently. The world expects businesses to have credit lines being run up and come down, and as you work through things, and that's what you're doing. You're in a business, and so you're going to be drawing down on credit, and then you're going to be using it, and then you're going to be paying it back. Drawing down on credit, using it, paying it back. And so for a business, you're going to want to be using, possibly if you can, unsecured business lines of credit. Now, what is an unsecured business line of credit? Just what it sounds like. It's a business line of credit attached to a company. So you do have to set up a company, either a corporation, partnership, LLC, something like that. And you are going to have to go out searching for a line of credit that is going to attach to that particular business. Now, the trick to this is, you hear the word unsecured, which means that that particular line of credit does not report on your personal credit report. So as you use the line of credit, it is not going to be whipsawing your score up and down as you utilize this in your real estate investing business, which is a good thing. However, don't get a little bit carried away with that, because you got people out there that are thinking, hey, I'll just run out, get however much I need in business lines of credit. I'll just go out there and just throw everything I can and just kind of be irresponsible in my real estate investing, not think about anything. And then if it all goes down the pooper, that's fine, because it's not tied to my personal credit report. I'll just let it burn. I don't have to worry about it. Doesn't quite work that way. See, it's unsecured, but that does not mean it is not personally guaranteed. So when you sign up for it, you are going to have to put your own signature on the line. And if you decide not to pay back the amount of money that you borrowers agreed, then that will negatively affect your credit report at that point in time. However, as long as you pay on time, it's really not going to, it should not, if it is a true unsecured business line of credit, show up on your credit profile. Now, the trick to this is these two different types of funding sources are, you got to go through different routes to get them. So home equity line of credit, pretty much straightforward. You visit your bank or you visit a mortgage broker, you say, I want to get a home equity line of credit on your home. You go through an application process and an appraisal process, just like any other similar mortgage style product. Unsecured business line of credit is a little bit more complicated. I can't even go into it here. My partner and I, we learned about this through a very outstanding course, and if you want to learn more about that, if you look in the show notes section down below, you'll see a link to that particular course that we used in researching how to get unsecured business lines of credit, and all the information will be there for you if you click through on that link. All right, let's go over pros and cons. So pros to lines of credit are that they are quickly accessible styles of funding. So you apply for them, you get approved for them, and then it just kind of sits there until you need it, unlike a loan where as soon as you got it, you have to start paying it back. So you can set up your equity line or your unsecured business line of credit and then go shopping for a house, and as soon as you find one, you have the funds and you can make cash offers. Cash offers are the best kind of offers because they set you apart from other investors. It gives you more leverage and bargaining power when you are going to be looking to purchase homes. So that is definitely one of the pros there. The cons, the negatives of credit lines, well, as we discussed on a home equity line of credit, could have negative impacts on your personal credit score if balances are going up and down like a roller coaster. Also, it's not really secure in that the banks can basically yank it at any time. Same goes for your unsecured business lines of credit. So that is some of the negative aspect there. Just you could have it today and be approved for it today and not have it tomorrow. So other than that, these are awesome ways to fund deals. If you need and you've got enough money to fund a purchase and you need a little bit more in order to fund the rehab, then hey, look, you can use this as combo or supplementary financing and go ahead and move forward with your plans to build your real estate empire. All right, that pretty much wraps it up for lines of credit. Next episode, we are going to be talking about my secret funding source. All right, so we'll be talking about that next episode. Stick around, and we'll see you next time on our Funding Fundamentals video series.